Welcome to our Savvy series. I'm Catherine Magana here with Rachel Ivanovich. And today we're going to have a discussion on what is a mutual fund. So we're kind of getting back to basics and basics of investing. So we thought we'd spend some time talking a little bit about what it is, understanding diversification and strategy. And so just to kind of kick it off, one of the things is mutual funds is really the foundation for some of our clients' portfolios. And we just want to make sure you understand what mutual funds are.
So at its core, the mutual fund is a pool of money from many investors. And this money is managed by a professional investment manager.
And so basically, when you own mutual funds, you may own multiple mutual funds, and there's obviously different types of mutual funds that you can have.
So you can have mutual funds that are collections of assets. They could be stocks, they can be bonds, they can be a combination of both. But with a mutual fund, instead of buying one stock or one bond, you're basically buying a basket of investments.
And so basically you're sharing kind of your strategy with other investors. So once again, it's a pool of stocks or bonds or cash or other types of investments. And so instead of participating in buying individual companies or bonds on your own, you're getting pooled with other investors, and it's usually professionally managed. There are active mutual funds as well as passive mutual funds. The active ones there's usually a money manager that you hire or work with. Passive can be tied to more indexes.
So think about this structure providing instant diversification, and this is one of the biggest advantages of mutual funds.
Yeah. And so how mutual funds work. So mutual funds price once a day, usually at the end of the market, so at the close. And at the end of the trading day, the price of the fund, it's called NAV, which is net asset value. And so basically the fund prices in the net asset value at the end of the day. So basically, depending on how the markets do or what the underlying investments are doing, that's usually how you'll figure out how your mutual fund has done. But also with buying a mutual fund, when you invest or buy a mutual fund, it trades at the end of the day as well. So if it's 9 o'clock in the morning and we put an order in to buy a mutual fund, you're not going to get the price at 9 o'clock of whatever the market's at. You're going to get the price at the end of that trading day. So it trades like a stock, but it's a little different of how it actually functions.
And stocks are different in that they do trade throughout the day, as you just mentioned. Yes. And like you said, mutual funds are bought and sold at the very end of the day price.
Correct. And so basically when you're investing in a mutual fund, if it's a active mutual fund, then the money manager or the strategy that it's in, they determine what to buy, when to sell, and how much risk to take within that investment. And so within that mutual fund, there are some internal fees that are part of it. And it's interesting being working with clients and being involved in this industry is we do disclose what the internal fees are. However, a lot of times clients don't understand is there are internal fees.
I don't think they realize that there are actually fees with mutual funds.
Yeah. So what happens is if there's a fee that's within the management, it gets priced into the NAV, the net asset value of that fund. So there are internal fees within some of these managers. You just don't see it as a line item coming out of your account.
If you are researching mutual funds online, they have expense ratios, so you may want to look at that. And so this is the cost of actually managing the fund. And while it may seem small, it can add up, and they can really have an impact on your returns over time.
Okay. So let's talk about why mutual funds matter for some investors.
So mutual funds, they solve a key problem for investors because oftentimes people don't want to be stock pickers, but they want to be diversified. So they ask the question, how do I diversify my portfolio without having to, pick individual investments?
Right. So instead of you buying 20 or 30 stocks on your own, once again, you can get pooled with other investors and invest in different strategies in the broad market. And so basically a mutual fund may hold 20 or 30 or even hundreds of stocks in different industries. So it is important to see, or as the advisors to work with our clients to see, okay, what's a good mutual fund? Also, we look at, is there any overlap with other mutual funds with some of the underlying investments?
Which is one of the mistakes people often
Yes,
make.
unfortunately, that does happen very frequently. And so one of the things with a mutual fund, what we also see is depending on how much money we have to work with. So if a client is based on their investable assets, if we are, depending on the strategy, once again, that comes into the financial planning that we do and figuring out what's the best investments. So depending on how much money we're working with, really will dictate what can we do with the investor. And some clients, we do have them in mutual funds. Some clients, we have them in other individual stocks or other portfolios, but we do look at all of that. But for today, we're just really focusing on the mutual funds.
And I think it's just important to know that, convenience doesn't replace strategy, and you do want to be working, with your financial advisor to decide what's best.
Yeah. So let's talk a little bit about the types of mutual funds. So there are several different types of funds that are available to you. So there are stock mutual funds. Even within stock mutual funds, there are large companies, medium-sized companies or small-sized companies. Also, there's international, emerging markets. There's a lot of different ways you can invest in stock funds. There's also bond funds. So there could be some short-term bond, fixed income bond funds that you own, which means a certain time period. So maybe it's 1 to 5 years. Or there could be intermediate bond funds, which means it could be 5 to 7 or 8 years, or long-term bonds, 10 or plus years. So once again, what kind of funds are you looking at? And then there's also balanced funds. So a balanced fund is a mix of stocks and bonds. So it's not uncommon to see a balanced fund to have about 60% stock and about 40% bonds. But that manager within that strategy does have, can fluctuate a little bit, but usually it's we see it's mostly like a 60-40 mix, but it could fluctuate a little bit. And then we touched on a little bit, there are index funds. And so these are considered passive kind of investing. So the index funds, there could be an S&P 500 index mutual fund you can invest in, or pretty much all the different indexes that you can invest in. So that's another way you can invest in mutual funds. And then there's also actively managed mutual funds, once again, where you have the different managers out there with different strategies. There's also some mutual funds that focus mostly on dividends or, what's the purpose of the underlying investment. And so that's what, once again, ties into how much money are we working with, what's the overall plan, and how do we get you diversified with your investment strategy.
And so with those actively managed funds, the managers are trying to outperform the market. And with index funds, they kind of aim to match performance of a specific market index.
Yeah. So it is important to know, if you are in a fund, what type of fund is it?
Exactly.
Is it a growth? Is it an income? Is it a bond? Is it a stock? Or what kind of investment is it? And once again, how does it serve you in your overall financial plan?
So the next segment let's talk about the hidden overlap problem, and we kind of touched on that. It's one of the biggest misconceptions that we see. Somebody may own several mutual funds, and they assume that they're well diversified.
Yeah. So what happens is potentially there could be overlap. So if you have multiple mutual funds, and then if you start looking at the underlying investments that they're in, so for example,
might be the same companies.
Yeah, so there could be a lot of overlap, which means they have the same positions in each fund. Mm-hmm. So you just want to see what's the weighting and look at, how much exposure do I potentially have in certain stocks that are in those strategies. So
because it could turn out that you, instead of being diversified, you have concentration in certain positions.
Yes. Okay, so where does mutual funds fit in your strategy? So mutual funds are basically an investment tool or investment option that you have, and they can be used for growth, income, and diversification. And so once again, we talked a little bit about financial planning, but the other thing that we look at is what are your goals, what's your timeline, and what's your risk tolerance, because everybody's a little different. And so kind of really putting together a strategy that works for you. And once again, mutual funds is a way to do that.
One of the things I've seen with taxation, I just wanted to touch on this here, is oftentimes mutual funds, if they are used in retirement accounts like 401ks, then the capital gain distributions that you receive from mutual funds aren't going to be taxable because 401ks or 403bs, they're retirement accounts. But if you have mutual funds in a portfolio that's taxable, oftentimes this is a surprise at tax time because people don't realize that the mutual fund income or capital gain distributions is taxable even if it's reinvested.
Well, it's interesting you say that because I can't tell you how many times I've had conversations and it may appear on paper that your investment lost, but the reality is if you add back the earnings or the reinvestment or the dividends or the distributions that get capital distributions that get paid, the total return is a lot different. But on paper, sometimes it looks like there's a loss.
Yeah, but I think that just is part of. We just need to do active planning with that and be talking to your advisors because nobody wants a surprise if all of a sudden you have $10,000 more of income because of those capital gain distributions, and you may not have it in your pocket, but for taxes, you have to pay tax on it. So you just want to make sure that you're planning ahead for that income that's being reinvested.
So let's talk a little bit about some other kind of common mistakes we see. Occasionally, there might be a sector or a fund that's doing very well. There are areas that fall in and out of favor. And so obviously you can't base it based on past performance. You really have to look at what am I invested in, kind of, how does it fit into my overall allocation? And obviously, we want to make money with your money, but there is some risk involved in making sure that we're not just jumping into something because it did well recently.
And we touched on it already, but ignoring fees is something that you definitely want to know what that expense ratio is and how much you're actually paying because it's not necessarily upfront. You have to be asking those questions.
Correct. And then obviously we talked about the funds that have overlapping positions. And then obviously we want to make sure that, over time your allocation may change a little bit. So if you're in different funds, occasionally maybe rebalancing makes sense.
And it's important to understand what's inside the fund so that you can truly gain that diversification that you're looking for and not have the concentration.
So let's kind of think about another way to think of mutual funds. Obviously, they're there to help you diversify. It's a way for you to invest and perhaps, once again, depending on how much money you have to work with, or there might be certain sectors that you want to invest in. So obviously, it's a way to implement a strategy, and there's a lot of different ways you can do it.
Tool.
Yes, and there's active, passive, or a combination of the two you can look at.
You really just want to understand what you're invested in because having that clarity, it'll lead to confidence and better investing.
Yeah. So we covered a lot today. One of the things that I did want to mention are there are some funds that are considered open-end funds and some that are considered closed-end funds. And then there are some investments that are called exchange-traded funds, also known as ETFs. And we'll have a whole nother discussion on that. There's a lot of similarities with those two, but we'll definitely kind of circle back and educate you on the differences and have a segment on ETFs. And so one of the things, that we also want to share with you with mutual funds is there are different share classes. So when you go to invest in mutual funds, there's different share classes. There's A, B, and C shares. And with each share class, there's actually different fees that are associated. And so once again, we talked about the different styles and types of mutual funds and being diversified, but also there's different share classes and fees associated. And really the importance of that is depending on like an A share, if you're going to hold a fund for a very long period of time, there are higher upfront costs with those and lower kind of ongoing fees. Whereas B shares has kind of similar or different pricing where they do have the expense ratios over time is a little higher, and then C shares is usually their advisory fees coming out of the C share, and then you're also being charged your kind of internal fees. So once again, there's a lot of detail that goes on with fees and structure. We're happy to go over that with you individually and see how that fits in. I know we covered a lot today on mutual funds. If you would like a complimentary strategy session, you can reach us at 760-692-5700. Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results, and the indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Savvy Woman Wealth Management is a registered investment advisor with the SEC.